Hey everybody, Joe here from Avalon. Since it was introduced in January of 2022, the underused housing tax has been causing massive confusion. Whether it's from the general public or Paul's WhatsApp group of extreme accounting nerds, the reaction has been pretty much the same. In this video, we're going to explain UHT in plain English. By the end, you'll know whether UHT applies to you and whether you need to file a return or pay any tax. We'll also take a look at the actual UHT return so you'll have an idea on how to file it. So all that and nothing else coming right up. The Underused Housing Tax is a federally mandated annual tax on the ownership of vacant or underused housing in Canada. It took effect on January 1st, 2022. UHT usually applies to non-resident, non-Canadian owners. However, in some circumstances, it can also apply to Canadian owners. The UHT rules include an annual reporting requirement and a tax liability that is calculated at 1% of the residential property's value. It's nearly as important to understand what the UHT is not. What I mean by that is that there are similar provincial or municipal programs that can confuse things a little bit. To help clarify, we'll look at what UHT is not. UHT is not BC's speculation and vacancy tax. This is a separate provincial program. It's designed to discourage housing speculation in designated areas of BC. Toronto's vacant home tax. The City of Toronto has a tax program levied on vacant homes that are not used as the principal residence of their owner. This is also different from the UHT. If you live in one of these areas, you may need to file these returns separately. UHT is also not a personal tax return, a corporate tax return, or a partnership return. It's important to know that the UHT return is filed separate from any of those other returns. All right, so now that we know what the UHT is not, we're moving on.
Everybody on? Good, great, grand, wonderful.
We'll be talking about the UHT in plain English in this video. However, if you look up UHT on the Government of Canada website, you may have to do some mental gymnastics to understand what the heck they're talking about. So here are a few important terms to understand when reading about the UHT. An excluded owner is someone who does not have to file or pay the UHT. If you're an excluded owner, don't worry about UHT. An affected owner is someone who definitely has to file a UHT return, but may or may not have to pay any underused housing tax. Exemptions relate to specific circumstances that exempt affected owners from having to pay any underused housing tax. The UHT Act uses the term carved out to explain when specific people are removed from an exemption. It's like saying that people wearing blue shirts are exempt unless the shirt has buttons. So blue shirt button people are carved out from the exemption. Keep this in mind when reading about the UHT to help maintain your sanity.
Go crazy?
Don't mind if I do.
Next up, we'll dive into who has to file a UHT return and who will have to pay the underused housing tax. Some people, affected owners, are required to file a UHT return. However, only a small percentage of UHT filers will actually owe any UHT. To determine your UHT obligations, follow these 5 steps. Step 1, determine if you are subject to the UHT rules. Step 2, if you are subject to the UHT rules, determine if you have to file a UHT return. Step 3, if you do have to file a return, determine if you need to also pay UHT. Step 4, if you have to pay UHT, calculate how much you owe. And step 5, once you know how much you have to pay, file your return and make your payment. But first, a disclaimer, this information is for educational purposes only and shouldn't be solely relied upon to determine UHT status. UHT can get quite complicated, so we recommend speaking to a professional if your situation isn't clear.
Talk to me.
The first step is determining if you have to worry about filing a UHT return or paying any underused housing tax. Ask yourself this question. Were you the legal owner of a residential property in Canada as of December 31st? You would answer yes if you were the legal owner, either as a person or entity registered on title of a residential property in Canada. The ownership can be jointly owned or otherwise. If not, you're not subject to the UHT Act. Stop here. Just hit the subscribe button and you can stop this video, but no need to file or pay anything. Or just keep watching to learn more. If yes, go to step 2 to see if you need to file a UHT return.
Now it says step Huh?
Step 2, we need to find out if you're required to file a UHT return. Excluded owners are not required to file a UHT return. If you are an excluded owner, you're not required to file a UHT return or pay the tax. Great, then we need to know what an excluded owner is. Here's where it starts to get a bit complicated. This is a list of what excluded owners are. Number 1, Canadian citizens or permanent residents are generally excluded owners. However, they're not excluded owners if they hold interest in a property as a partner or as a trustee. This means that if you own a property as a partner of a partnership, then you are carved out from this exemption. If that's you, then you would need to move on to step 3. Also, if you own a property as a trustee of a trust, then you are carved out from this exemption. If that's you, then you would need to move on to step 3 as well. Unless you're a personal representative of a deceased individual, then you're still an excluded owner. 2, corporations that are both incorporated federally or provincially in Canada and are traded on a Canadian stock exchange are excluded owners. These businesses don't need to file or pay UHT. Conversely, private corporations like Avalon Accounting Inc. are not excluded owners and would need to move on to step 3. Now there's a big list of excluded owners that don't need to file or pay UHT but likely don't watch these videos. I will go through these really quickly. Registered charities, cooperative housing corporations, municipalities, Indigenous governing bodies, and corporations owned by such entities, government entities, publicly traded trusts, public service bodies like universities, public colleges, school authorities, and hospital authorities. So in step 2, your task is to ask yourself if you're one of the excluded types that I just named. If you are an excluded owner, you do not have to file a UHT return. You don't have to pay anything either. Now it's your turn to hit the subscribe button and you can stop here. If you're not an excluded owner, then you are an affected owner and are required to file a UHT return. Affected owners get to move on to step 3 and find out if they have to pay any UHT. But first, let's quickly revisit the most common type of excluded owners. These are Canadian citizens or permanent residents who are homeowners. As long as these people don't own the home as a partner or trust, they're typically excluded owners and don't need to file a UHT return or pay any UHT. Spouses who co-own a residential property are typically excluded owners as well. Co-own being the important term here. Co-ownership is different from owning a property as a partner or a partnership. Check out the link in the description for more information on co-owners versus partners to help clarify the difference. Okay, moving on to step 3.
Right, let's move on.
Step 3 is where you'll find out if affected owners, those who must file a UHT return, have to also pay the UHT. All those who made it to step 3 have to file a UHT return, but not all have to pay the UHT. If you meet any one of the exemptions below, no tax will be payable when you file your return. You would still need to file the return, but won't actually owe any UHT because you would be exempt from the tax. There are 4 main categories of exemption, and I'll discuss the details of each category. Exemptions can be based on the type of owner of the property, the availability of the property, the occupancy of the property, and the location and use of the property. Let's start with the exemptions based on the type of owner of the property. The following types of property owners are exempt from paying the UHT. They may still need to file a UHT return though. Specified Canadian corporations, where foreign owners do not control directly or indirectly 10% or more of the corporation by share value or voting rights. Specified Canadian partnerships, where each member is on December 31st an excluded owner or a specified Canadian corporation. Specified Canadian trusts, where each beneficiary has a beneficial interest in the property, is on December 31st an excluded owner or specified Canadian corporation. New owner, an owner who acquired the property in the year and was not an owner of that property in the prior 9 years. Deceased owner, an owner who died in the year or prior year. Representative of the deceased owner, a personal representative of a deceased individual. The exemption applies for the year of death and subsequent year. This exemption does not apply if the representative was also an owner of the property in either year. Co-owner of a deceased owner, a co-owner of a property where another co-owner owned at least 25% of the property at their death. The exemption applies for the year of death and the subsequent year. Specified Canadian corporations, partnership, and trusts are defined specifically. Check out the link in the description to determine exactly what those are. Next, we have exemptions based on availability of the property. The following states of property availability provide an exemption from paying the UHT. Owners may still need to file a UHT return. Under construction, properties that are under construction and not substantially completed before April of the year. New construction held as inventory. Properties that were constructed and substantially completed between January 1st and March 31st, and the property is up for sale to the public during the year, and the property was never occupied by the individual as a place of residence during the year. Not suitable for year-round living. Properties that are not suitable to be lived in year-round or are seasonally inaccessible due to lack of year-round public road access. Uninhabitable from disaster or hazardous conditions. Properties that are uninhabitable at least 60 continuous days in the year due to disaster or hazardous conditions. This exemption is only available to a maximum of 2 years in respect to the same disaster. Uninhabitable from major renovations. Properties that are uninhabitable for at least 120 consecutive days in the year due to ongoing major renovations. Now, this exemption is only available once every 10 years. Another term that needs defining is substantially completed. We've linked that in the description below as well. Next, I'll list exemptions based on occupancy of the property. The following types of occupancy of a property provide an exemption from paying the UHT. Owners may still need to file a UHT return though, so watch for that. Primary place of residence. Properties that are the primary place of residence for the year of the individual, their spouse or common law partner, or their children attending a designated learning institution. The definition of designated learning institution is linked in the description below. Qualifying occupancy. Properties that satisfy one of the following qualifying occupancy scenarios are exempt. In each scenario, the individual must occupy the property for at least 1 month for a total of at least 180 days in the year. For example, if an individual occupies the property in January, April, May, September, October, and November, this would count as 183 days total, and each period of occupancy was at least 1 month long. Qualifying occupants can include arm's length individuals that occupy the property under written agreement. Non-arm's length individuals who occupy the property under a written agreement and pays at least fair rent, at least 5% of the value of the property annually. Owner or their spouses or common law partner who occupied the property while the individual is in Canada for work and the occupancy relates to that purpose. Owner, spouse, or common law partner, parent, or child who occupies the property and is a Canadian citizen or permanent resident. I told you that it gets a bit complicated. Oh, hey, last list. Exemptions based on location and use of the property. The following location and use of the property provides an exemption from paying the UHT. Owners may still need to file a UHT return though. Vacation properties are located in an eligible area of Canada and used by the owner or their spouse or common law partner for at least 28 days during the year. Use the vacation property designation tool linked in the description below to see if your property falls into one of the eligible regions. Step 3 is to ask yourself if you meet one of the exemptions that I just listed. If you meet one of the exemptions above, you do not have to pay UHT, but you still need to file a return. If this is you, skip step 4 and go to step 5. If you do not meet one of the exemptions above, you will need to file a return and pay the UHT. Go to step 4. If you've gone through the steps and you do need to pay the UHT, here's how to calculate what you owe.
That's as good as money, sir. Those are IOUs.
UHT is calculated as 1% of the greater of the property's assessed value for the year for property tax purposes and the most recent sale price applied to the ownership percentage. An owner can also elect to use the property's fair market value as determined at any time during the year and up to April 30th of the following year. CRA requires an appraisal with specific parameters for a property owner to use this election. Complete step 4 by calculating your UHT balance owing. Then go to step 5 to file your UHT return and submit your payment. Now that you've determined you must file a UHT return and potentially may need to make a payment, it's time to file your return. Step 5 is to file your UHT return or returns. You're required to file a return for each property that does not meet one of the exemptions. If you owe anything, you will also need to pay your UHT balance. Your UHT return, called the Form UHT 2900, must be filed by April 30th. If April 30th falls on a weekend or a public holiday, your return is due on the next business day. There we go. You've now completed the 5 steps to determine your UHT status. If you have to file a UHT return, You should probably keep watching to see what that looks like.
I can't wait to see it.
Now that we know who has to file a UHT return, let's take a brief look at the sections that need to be completed within the return. You'll be completing the form UHT 2900 and then mailing it or faxing it to the applicable tax center. Pop UHT 2900 into Google and you'll find a fillable PDF. There is quite a bit of information you will need to include on this form. At Avalon, we recommend that our clients fill out their own forms so they're not paying an accountant $150 to $250 per hour to hunt down this info and do some data entry. Then, if you have questions, it makes sense to consult your accountant to get help with the tricky parts. All right, let's get into the actual parts of the return. Part 1 is just information about the property owner. Gather up the required info that you see on the side here and fill in information about the property owner or owners. You will need your partnership or trust numbers if applicable. In Part 2, you'll be including information about the property in question. This includes things like the address, property ID, or property tax assessment roll number, if applicable. You'll also need to include the assessed value of the property and the most recent sale price. Part 3 only applies to individuals who are neither Canadian citizens nor permanent residents of Canada. It doesn't apply to individual Canadian citizens, individual permanent residents, or corporations. Part 4 applies to individual owners that are exempt from paying UHT under the primary place of residence exemption. These owners will need to fill out Part 4 to claim the exemption. Next up, we have Part 5 of the return. Part 5 should only be filled out if you are claiming the exemption for qualifying occupancy. And then Part 6 should be filled out for pretty much any of the other exemptions. You can see a full list of applicable exemptions within Part 6. If you're electing to use the fair market value election for the residential property, you would fill out Part 7 to do so. Use Part 8 to calculate your balance of UHT owing. You'll need the property's taxable value and your ownership percentage here. Then finally, in Part 9, you will certify the UHT return and fair market value election if applicable. Have a read through your return and print your name. Then sign and date the form. Once you've completed the return, you can mail or fax it to the applicable tax center. There are 2 tax centers that are accepting UHT returns. And you'll just choose the applicable tax center based on your situation shown in the 2 images on the screen. I'll keep these on the screen for a couple of seconds so you can pause if you need to. These are also listed on one of the info pages on the actual UHT return. Alright, so that does it for the confusing topic of UHT returns. If it didn't totally stick on the first viewing, don't worry. You can always view our blog post on the subject linked in the description below. I hope you found this video useful. Our goal is to produce the least confusing UHT resource out there. Please let us know how we did in the comments. We love helping small business owners, and creating these videos is just one of the ways that we do that. If you're not subscribed to the channel, please consider hitting that subscribe button. It really motivates us to put more useful content out there. Thanks for watching, and we'll see you in the next video. Cheers.